At the age of 39, Donald did something most of his peers could only dream of. He carefully rolled up the final blueprint of his corporate career, handed in his keys, and locked the door to his architectural studio for the last time. After 2 decades of designing homes and offices, spaces for living and working, he was designing a new life for himself. His retirement wasn't funded by a modest pension alone, but by a formidable investment portfolio valued at over $1 million. Rewind 16 years. On his first day as a junior architect at 23, the idea of retiring early was a distant, almost unimaginable fantasy. He was passionate about his craft, the elegant symmetry of structures, the rhythmic flow of lines on a drafting table. But he also observed a different, more sobering blueprint among his older colleagues. A life of living paycheck to paycheck, the constant, low hum of financial anxiety, and the weary countdown of years until a mandated retirement age. This is the story of the 3 distinct stages of Donald's journey to financial freedom. We'll explore what he focused on, the costly mistakes he learned from, and how his ultimate advantage wasn't a stroke of genius, but an unwavering, systematic consistency. And crucially, we will reveal the actual calculations, the hard numbers that chart the growth of his wealth from that first salary to a 7-figure fortune. Stage 1. Laying the foundation. Donald's starting salary was respectable, but far from extravagant. $60,000 annually, which translated to about $5,000 a month after taxes. He made deliberate choices from the outset: a modest apartment, public transportation, and a conscious resistance to lifestyle creep. He was building a financial foundation as meticulously as he would a building's foundation. The pivotal moment came during a late night at the office. While sketching under the lamplight, he noticed a colleague reading Napoleon Hill's classic, Think and Grow Rich. A single passage seemed to leap from the page. Every time you spend money, you are giving away something that could earn money for you. Pay yourself first. That idea resonated deeply. It was a paradigm shift. The very next payday, he instituted his core financial strategy, an automatic transfer of 20% of every paycheck directly into a brokerage account. In concrete terms, this was approximately $1,000 from his base salary, and often more with bonuses, every single month. His initial foray into investing was pragmatic. He focused on large, established companies in industries he understood: construction materials, infrastructure firms, and household name tech giants. But the market is a stern teacher, and Donald was about to learn his first difficult lesson. He got caught up in the excitement around a green architecture materials startup, hyped by a friend. It promised revolutionary products. Swept up in the fervor, Donald invested $3,000. To his astonishment, it skyrocketed to $7,000 in just a month. But as swiftly as it rose, it collapsed, plummeting 90% before the company eventually folded. The $3,000 was gone. It was a sting that could have derailed a novice. But Donald didn't panic. He absorbed the lesson. Speculation is not investment. He returned to his system, more committed than ever. Through relentless frugality and consistency, Donald accumulated his first $30,000 in just 2 years. This wasn't the result of a lucky break. Let's look at the numbers. His total deposits amounted to $27,000. The remaining $3,000 came from dividends and modest capital gains, with his portfolio averaging a 10% annual return. The foundation was poured, and it was solid. Stage 2, building momentum. This 6-year period was where the physics of finance began to work in his favor. This was the power of compounding. Donald continued to focus his investments on stable, dividend-paying stocks in understandable sectors. But another painful and perhaps more profound lesson was looming. During a sudden and sharp market downturn, the financial news was saturated with panic. One of Donald's best-performing stocks fell 25% in a single week. Fear took over. Visions of it dropping to zero clouded his judgment. Against his own better knowledge, he sold his entire position, crystallizing a loss. That single decision wiped $10,000 from his portfolio. Just a month later, the market stabilized and began its recovery. That very stock not only bounced back, but soared to new heights. Donald had converted a temporary paper loss into a permanent, real one. It was a turning point. He made a vow to himself: never again. He wrote Warren Buffett's most fundamental rule on a sticky note and placed it above his desk. Rule number 1: never lose money. This new discipline was soon tested. Not long after, a cloud computing IPO was the talk of the town. Everyone was piling in, promising instant riches. But Donald, now a devoted student of Buffett's philosophy, asked himself the critical questions. Did he understand the business? Did it have a durable, sustainable competitive advantage? The answer was no. He walked away. The IPO briefly soared, then catastrophically crashed by 80%. By sticking to his blueprint, reinvesting dividends, studying financial statements, and making deliberate choices, Donald's portfolio grew steadily. By age 32, he had quietly amassed $201,000. The breakdown is telling. $135,000 came from his own systematic deposits, but a significant $65,000 was generated by the portfolio itself through reinvested dividends and capital gains. The engine was now humming. 3. The final ascent. At age 33, the ultimate test arrived. A major economic correction hammered the stock market. Stocks were in freefall. On paper, Donald's portfolio was eviscerated, dropping to a gut-wrenching $75,000. He had watched years of progress seemingly vanish. But this time, he was prepared. He remembered the sting of his panic sale and recalled Buffett's other famous adage: be fearful when others are greedy, and greedy when others are fearful. Instead of selling, he doubled down. This was the moment his entire journey had prepared him for. He used every spare dollar of his savings and, believing so strongly in the opportunity, took a strategic loan to buy shares of high-quality companies at fire sale prices. In total, he invested an additional $125,000, bringing his total portfolio value back to its pre-crash level of $200,000. It was a terrifying but profoundly disciplined move. To manage the debt, he leveraged his architectural skills, starting a side project, designing and selling minimalist modular furniture online. The profits, a few $1,000s a month, were funneled directly into loan repayments. His conviction was rewarded. The market stabilized and within 2 years had returned to its previous valuation. But Donald's portfolio, supercharged by his courageous buying at the bottom, didn't just recover, it exploded. In those same 2 years, it more than doubled, reaching $700,000. Of this, $350,000 was his total capital invested, and an equal $350,000 was now pure growth from dividends and capital appreciation. At 35, a promotion to project lead came with a substantial bonus and profit sharing. While others might have upgraded their lifestyle, Donald saw it as rocket fuel for his escape plan. He channeled every extra dollar into his portfolio, accelerating his loan repayment and boosting his investments. And then it happened. Sometime after his 39th birthday, after more than a decade and a half of relentless saving, disciplined investing, and strategic side hustles, Donald's portfolio quietly crossed the seven-figure threshold. The final tally: $1 million. Of that, $400,000 was the total capital he had deposited over 16 years. The other $600,000 was created entirely by the multiplicative power of the market, reinvested dividends and capital gains. His brokerage account was no longer just numbers on a screen. It was a living, breathing engine of freedom. The dividends and growth it generated were now more than sufficient to cover his living expenses. The calm and relief he felt were palpable. Donald didn't just hope for freedom, he built it, line by line, dollar by dollar. Epilogue. The blueprint for freedom. Today, Donald sketches for pleasure, not for deadlines. He travels, restores an old house he's always admired, and mentors young architects, not just in design, but in the art of financial design. When asked for his secret, he often smiles and offers this: "I stopped listening to the noise and started following a system. I paid myself first, and I harnessed the eighth wonder of the world, compound interest. As Albert Einstein reportedly said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." His story isn't about a lucky stock pick or a sudden windfall. It's a testament to a repeatable system. Automate your savings. Make wealth building a non-negotiable expense. Invest in what you understand. Clarity trumps hype. Don't panic sell. Volatility is a test of discipline, not a signal to flee. Let time do the heavy lifting. Compounding is your most powerful ally. Donald built his freedom not on a massive salary, but on a massive intention and unwavering consistency. He followed the blueprint. If you found Donald's story inspiring, hit that like button, share it with someone who needs it, and subscribe for more real-world stories and practical strategies to build your own freedom. Keep learning. Keep growing. Your blueprint starts today. You can also check out the 2 videos on screen right now. One breaks down the painful crypto mistakes I made in 2021 and 2022 and the lessons I learned, and the other dives into how money works and basic finance concepts. See you in the next one. Stay sharp, stay rational.